Thank you for submitting your answers. Here are the poll results. They should be displayed on the screen shortly. And over to you, Esther.
May we invite Esther to give her introductory remarks?
Okay, hi everybody. Thank you and welcome again. So what happened is actually this is the third session of the webinar, and the last two sessions we have heard from the regulators. We can also heard from standards such as TCFD, CDP, and we have also heard from experts regarding the how to help SME to do better reporting. So this time we are really excited because in the next 85 to 90 minutes or so, we will hear from our primary target audience of our sustainability report. What investors think will help us report better and disclose more meaningful and useful ESG data. And this poll can actually also show that majority of the audience today are listed company, and they are also producing a sustainability report. And the second question is also, the main reason for them to actually produce a sustainability report is actually not so much voluntary. It is mainly regulatory requirement, and of course they also feel that almost the same, 40%, that they feel that reporting actually help improve reputation and performance. This is really a good sign. And the third one is, of course, the audience today and also the companies are actively engaging investor. This is good to know. Maybe we can hear from the investor later on. But there are also almost 40% that they are not engaging investor as yet. So we will hear, how we can do better in this, the communication with investors. And I'm really surprised that 50% of the company actually somewhat know that what investor really want. Yeah, being a reporter for 14 years now, I would like to share that I have to be honest that sometimes we also, yes, somewhat clear, but we want to improve, as much as we can. Okay, yeah, without further ado, let me introduce our really powerhouse, passionate, insightful panelists. The first one is James Robertson, who is the head of Asia, excluding China and Japan, from the Principles of Responsible Investment. And the second, a lot of people are familiar with Shinbo, who is actually the Director of Investment Stewardship, BlackRock, and a very active advocate of ESG. And last but not least, Chitra Hepburn is also a very active speaker in the ESG arena, and she is the head of APAC ESG client coverage from MSCI. So without further ado, maybe I can just pass the stage to James.
Hi there. Thank you so much for the invitation to participate, Esther, and delighted to be with all of you to present today. So what I'm going to be doing, if you just give me one moment to share my screen. Excellent. Is to set the scene a little bit before Shinbo and Chitra present in terms of sustainability within the investment industry. So just again to introduce myself, my name is James Robertson and I work for the UN-supported Principles for Responsible Investment, or PRI. So for those of you who may not be familiar with the PRI, we are an investor-led global nonprofit initially established to help better understand the investment implications of environmental, social, and governance, or of course ESG issues, and to support our members, or what we call signatories, in integrating these into their investment and ownership decisions. So those signatories commit to implementing the 6 principles for responsible investment, which you can see on the screen here, which assert the importance of a structured and formalized approach to the incorporation of these issues into analysis and investment decision-making and their stewardship activities. So these members join as a way, of course, to learn, to demonstrate leadership and commitment to responsible investment, and to contribute and collaborate as part of a global network of investors.
Sorry, James. Sorry to interrupt. Your screen is could you maximize your screen? It looks very narrow on our end. Yeah, that's great. Looks wonderful now. Thank you.
Okay, no problem. So when we think about the underlying goal and direction here, at the core of the PRI's mission is the belief that an economically efficient and sustainable global financial system is a necessity for long-term value creation, and that such a system will reward long-term responsible investment and benefit the environment and society as a whole. Now, it's important to note that the PRI exists as part of a much wider ecosystem of stakeholders and collaborative initiatives, all working towards sustainability within the financial system and the broader economy. So this includes the PRI's 2 UN partners. So firstly, the UN Environment Programme Finance Initiative, which established the principles for responsible banking in late 2019, which now has over 230 banks signed on, and also coordinates the principles for sustainable insurance. And also the UN Global Compact, which is a non-binding United Nations pact which encourages businesses and firms worldwide to adopt sustainable and socially responsible policies. And that has over 12,000 companies participating from over 160 countries. So these are entities, alongside others, that at a global, regional, and national level are working to drive progress on sustainable finance and responsible investment. And there is often extensive collaboration amongst many of these stakeholders. So to highlight some examples here, in 2009, the PRI, along with our 3 UN agency partners, launched a Sustainable Stock Exchange Initiative. Its mission is to build the capacity of stock exchanges and securities market regulators to promote responsible investment in sustainable development and to advance corporate performance on ESG issues. And it now has over 100 partner exchanges. Another is the Investor Agenda. So this is a platform for accelerating action towards a low carbon world. And the coordination is led by a group that includes a number of regional investor groups dedicated to climate action. So these stakeholders, including the PRI, have also established initiatives like the UN-convened Net Zero Asset Owner Alliance and the Net Zero Asset Manager Initiative, whose institutional investor members commit to transitioning their portfolios to net zero greenhouse gas emissions by 2050. And lastly, there is the NGFS, or the Network for Greening the Financial System, which is a network of 83 central banks and financial supervisors that aim to accelerate the scaling up of green finance and develop recommendations for central banks and their role for overseeing climate change. So all of these organizations alongside the PRI are driving a push towards a more sustainable financial system across different sectors. And we're increasingly seeing participation and support from amongst Asian investors, banks, regulators, and other key stakeholders. And this in turn has impacts on how these entities interact with the companies they're invested in. To take a step back, what is responsible investment? How is it done? So the PRI defines this as a strategy in practice to incorporate ESG factors in investment decisions and active ownership. Understanding investor approaches can help to shine light on how sustainability related data is used. And so I just wanted to briefly explain 2 areas here. The first is ESG incorporation. So when investors are building an investment portfolio, they'll be utilizing data on ESG issues and incorporating these into their investment practices, often combining one or of three approaches. So firstly, integration is the systematic inclusion of data on ESG issues in investment analysis and decisions, done to help better manage risks and improve returns. Screening is applying filters to lists of potential investments to either rule companies or sectors in or out of contention. So this could be exclusionary, so based on an investor's preferences, values, or ethics, such as excluding sin stocks. It could be utilizing a company's performance on ESG issues, or using an ESG score or rating, such as those provided by MSCI, to put in place either a negative screen for lower performing companies or a positive screen for high performing companies. And lastly, you have thematic investing, which is seeking to combine an attractive risk return profile with an intention to contribute to a more specific environmental or social outcome. Now, the second area, and just as important, is called active ownership or stewardship. And here, investors can encourage the companies that they're already invested in to improve their ESG risk management and develop more sustainable business practices. So this can actually be the more impactful aspect of responsible investment in supporting and driving change. It can be done through proxy voting on shareholder resolutions, for example, but also through engagement, both individually and increasingly collaboratively with other investors. This engagement may seek to get a deeper or more nuanced understanding of the sustainability-related risks and opportunities for a company and how these are managed based on the corporate disclosures around ESG issues that you're making. So one thing that's undeniable is that interest in responsible investment and application of these practices is picking up pace. So from an initial group of 100 investors that founded the PRI, we have now grown to over 4,000 signatories, managing a combined total of over 120 trillion US dollars in assets under management. And this includes some of the world's largest asset owners, investment managers like BlackRock, and service providers like MSCI. And this growth is often referenced as one sign that sustainability is becoming mainstream. So indeed, last year we saw record inflows into ESG funds, and we expect this trend will only keep growing. And as we see the ongoing mainstreaming of responsible investment and a growing range of investment products focusing on these areas, we will only see greater demand for and use of sustainability-related data. Now, briefly, to help understand the mainstreaming of responsible investment and sustainability issues, it's valuable to be aware of the drivers involved here. So firstly, materiality. It's a recognition within the finance industry and in academia that ESG factors influence investor returns. So they have the potential to be material to performance, both in determining risk and in return. And as such, considering these ESG issues can be viewed as part and parcel of fulfilling an investor's fiduciary duty. Secondly, there's market demand. So this is coming from asset owners and their beneficiaries who are increasingly calling for greater transparency around how and where their money is invested. And this is actually particularly strong around millennials and younger generations, which is very important when we consider the huge transfer of wealth between generations we expect to see in the forthcoming years. And it's driven both by a growing awareness that ESG factors can influence company value, returns, and their reputation, but also by an increased focus on the environmental and social impacts of the companies that they're invested in. Lastly, here we have regulation. So since the mid-1990s, responsible investment regulation has increased significantly. Regulatory change has been driven by a realization among national and international regulators that the financial sector can play a role in meeting global challenges such as climate change, modern slavery, tax avoidance, and supporting capital flows into frameworks like the UN Sustainable Development Goals. Across the world's 50 largest economies in the last decade, there have been over 730 hard and soft law revisions to some 500 policy instruments. And these support, encourage, or require investors to consider long-term value drivers, including ESG factors. And to support and facilitate this, we've then seen stock exchanges introducing and refining sustainability reporting requirements for corporates, most recently around climate change. So the last thing I wanted to finish on was this graphic, which highlights the PRI's priority work areas over the next 3 years. And I believe this serves to demonstrate how this space is developing, as these priorities are based on feedback from our 4,000 plus signatories. And given the PRI's position and influence, our activities can often play a significant role in driving key trends in responsible investment, and can impact the types of interactions and expectations that investors have of the companies they're invested in. So alongside strengthening ESG incorporation and increasing those stewardship ambitions I mentioned earlier, you can also see a greater focus on social issues in the wake of COVID-19, a drive to secure net zero commitments from investors. And particularly for long-term investors, they're looking at how their investments can support delivery of the SDGs, and aligned to this, a focus on outcomes to better understand the effect their portfolio, and through this, the activities of the companies that they're invested in, are having on the world. So I'll stop there, and sure you'll hear from both Shinbo and Chitra building on these themes even more. And I look forward to taking your questions in the panel discussion later today. Thank you.
Thank you so much, James. I think we had heard all the, the buzzword about how investor can really drive ESG and also drive this global race to zero. I still remember that Larry's letter, to CEO, is really a must read for everyone, almost like a New Year gift to everyone, whether it's corporate or investors. And this year, he highlighted that it's really about net zero. Just climate strategy is not good enough. And it's very clear that if investing company who do not have a net zero emission strategy and goal will risk divestment and voting against directors. So now I think it will be really the best time to hear from BlackRock, the world's largest asset manager. And Shinbo, over to you to address all our anxiety. Thank you.
Hi, thank you for that kind introduction, Esther. It's a great pleasure to be here. It's a great honor to be on the panel with both James and Chitra, and of course yourself. Let me just try to get my slides on the screen.
Looking good. We just need to have it.
Do you
screen?
See it? Okay.
Yes, I can see it full screen. Yes, thank you.
Sorry.
Okay. Yeah, it went back. Yeah. Okay, this is good. Thank you.
Sorry, I'm actually not seeing anything on my screen, which is odd. If you give me a minute, I can figure this out.
Yeah. Well. While you thought you are very familiar with Zoom, I forgot to unmute myself just now. After 80 such events this year.
I have no excuse. Okay, so
it looks good
now.
Yeah.
Do you have visibility? Yeah. Okay, great.
Yes, we can.
Oh, okay, great. So good afternoon, everybody. Just to introduce myself again, my name is Shinbo Won. I head the BlackRock Investment Stewardship team for Asia ex-Japan, based here in Singapore. So today, I promise I'll try my best to keep this short, but I'd like to do a short introduction to our firm, BlackRock, our team, the BIS team or investment stewardship team, and why we are so focused on engagements with companies on sustainability issues. So first, a brief introduction of our firm. As of end of June this year, we were entrusted to manage $9.4 trillion of our clients' assets. We have 16,000 employees across 35 offices globally, serving clients in more than 100 countries around the world. And it is important to distinguish that we are a fiduciary asset manager, i.e. the money that we manage are not our own, they're entirely our clients. And these clients include more than 100 institutions such as pensions, insurers, as well as governments who themselves are managing money for the long term to help individuals fulfill their long-term financial goals, such as buying their first homes, their children's education, and retirement. And in APAC alone, this means that we are responsible for more than 1 billion individual savers and 300 million retirees, those who are behind our institutional and large clients that we serve directly. So naturally, we take this fiduciary responsibility very, very seriously. And as James has mentioned earlier, we are very proud signatories to the PRI. And to us, our investment stewardship is a key function in fulfilling our duties as a responsible investor and fiduciary to the clients that I just mentioned. So from the perspective of a long-term equity investor or a shareholder, our team is responsible for primarily 3 tasks. So we engage directly with our investee companies, ideally with the board or management, on governance of material issues that impact long-term value of the company. And increasingly, this involves discussions around ESG issues unique to that company. And we vote on all the shares that we hold across our global portfolios to voice our support or concern to advance our expectations around governance and sustainability. And lastly, we promote thought leadership through engagements with various stakeholders, so outside of the investee companies, to advance corporate governance and sustainability practices. And that's the context of why I'm doing this panel today. And as you can see on this map, we continue to invest very heavily in putting the right people on the ground to broaden our engagements across the globe. This data is from January this year, so it's a slightly outdated, but we have close to 70 people now around the world and more than 20 here in APAC alone to advance the dialogue with companies and broader stakeholders. And I'm proud to say that as a stewardship function, we do have the largest stewardship team among all asset managers in the world. And this is something that, Esther, you have referenced earlier, but in January 2020, through Larry's letter to CEOs, as well as to our clients, we made a commitment that we are going to put sustainability at the heart of how we invest, manage risk, and execute our stewardship commitments. And that by doing that, it is in our fiduciary duty to do so, as we believe that climate risk, as well as the broader sustainability risks, are all investment risks. And how they are managed play a critical role in the value of the companies or the assets that we invest on behalf of our clients. So we have promised to reduce ESG risk in our actively managed portfolios, including divesting from companies where thermal coal is a meaningful contributor to that business. And to our investee companies, as shareholders, we have put forward 2 very explicit asks. Perhaps maybe this could answer some of the questions during the panel later, but we basically went out and asked companies to strengthen their disclosure around how they are managing climate risk by reporting to the TCFD framework and around the broader scope of ESG risks using the SASB standard. And as everyone in this audience is well aware, this was not really a surprise. We were not the only ones interested in these topics of climate risk or sustainability in general. And in 2020, what we have observed is that despite the challenges of COVID-19, we have seen some very meaningful shifts take place in the capital markets, in policies, and in the general public mindset around the world. We have seen more than 100 governments, more than 1,000 companies make or announce their plans to commit to net zero. This includes countries like China, Japan, and Korea here in Asia. We continue to see investors and banks walk away from carbon-intensive sectors like coal, and fundamentally altering the cost of capital for some companies in certain sectors. And even in developing and emerging markets, we saw very strong policy shifts towards renewable energy. And perhaps most visible trend, and this was referenced earlier by James, was this tremendous amount of capital that was flowing towards ESG or sustainable investing, really highlighting the demand among our clients, asset owners out there in the world, to invest into solution providers to these challenges, or into companies who are future-proofing themselves in this huge wave of transformation that is taking shape. And in the wake of all this, and I'm sure Chitra will be able to share a lot more insight on this, the demand for consistent, comparable, and good quality data around climate, around broader ESG factors have intensified very, very significantly. So in 2021, this year, we continue on with our commitments to mitigate climate risk to our clients' assets, and announced our commitment to support the goal of 2050 net zero greenhouse gas emissions. And to play our part, the stewardship team is strengthening our engagement with companies to essentially understand how they're mitigating climate risk, as well as looking at opportunities that companies are looking at that this net zero transition is presenting to them. And on top of the TCFD and SASB reporting ask that we put forward in 2020, we are now asking companies about how they're thinking about their business plans. How is that aligned to the Paris Agreement goals? So essentially limiting global warming to well below 2 degrees, ideally to below 1.5 degrees. And on the voting front, we have also revamped a lot of approaches on how we hold the board and management to account. We also see a significant rise in shareholder proposals this year, asking companies for that exactly, for plans and targets around achieving net zero. And this is an area where we have also altered some of our approaches and our views in executing our stewardship duties in voting to align our vote directions with what we believe is more aligned to our clients' long-term interests as well. And perhaps, we are fully aware that these are very challenging times for companies, particularly those who are early in their journey towards sustainability. And this slide perhaps is my key message for today. Despite the urgency around climate, it is a long-term path that we are all embarked on, and the board's leadership is critical in setting their companies in the right direction. And investors look to the board for their insight as well as oversight on these strategic matters. And that's because a company's approach, their intentions, their action strategy towards climate and sustainability in general, it's all about governance. It is about long-term strategy. It is about opportunities, not just risk. And it is about sustained value creation. How are you going to do this? Not just about cost of implementing or cost of compliance. It is about a roadmap that is very unique to that company, and it is not about compliance at all. And it is about engaged leadership, not about marketing. And so to help companies, especially those early in this journey, I'd like to take a minute just to bring to your attention maybe a resource that could be helpful. It is a practical paper that BlackRock, alongside many other institutional investors active in this region, and who are all members of the ASIFMA, or the Asian Securities Investments and Financial Markets Association, we have all come together using our experience engaging with companies in Asia and put together a helpful guide. And it provides an easy to understand guideline around why ESG is important to both investors and to companies, and what investors expect, and what are some of the best practices that we see and some of the pitfalls that we also see amongst companies in Asia. So I would recommend everybody in the audience to visit the site and download this. This is available for free, and hopefully this will help us take on our engagements and dialogue in the future. So with that, I will stop. Thank you very much.
Thank you, Shinbo. And before I invite the next speakers to start, and don't forget to post your question using the Q&A button. Indeed, Shinbo, 2020 actually we call it a year of awakening of many things: climate action, ESG, sustainability, and I'm really glad that you are, presenting a few issues, not just about data, but also about long-term strategy, leadership, and all. And but no matter what, the underlying message is about data, quality of data, transparency, and all that. And then I'm sure that the next speaker, Chitra, Hepburn, is going to share with us how important data it is, and of course, MSCI is really a gold standard for sharing all this data. And over to you now, Chitra.
Thank you, Esther. Fine, good afternoon to all of you. Thank you so much for having me here. It's an absolute honor. I enjoy presenting alongside such an esteemed panel. James and Shinbo, we know each other, but I have to say every time they speak, they impress me. So after having heard a little bit about sort of the 50,000 foot view perhaps from the UNPRI, and then hearing from a very large investor such as BlackRock, I'll be giving a view from if you like, from a data perspective and from a solutions perspective. So just a bit of introduction about MSCI. It's a global provider of critical decision support tools and services for the global investment community. So we enable clients to understand and analyze key drivers of risk and return, and we create research enhanced solutions to give insight into and also improve transparency across the investment process. So we rate companies on their ESG performance on a AAA to CCC scale, and we also have a climate change related score, which we put against these companies as well. So we rate more than 9,500 companies across the world, and then a whole host of sort of fixed income securities as well. We've got 300 ESG analysts who do all this work and work meticulously on the journey from data to ratings. We also use that data to create indices, not just climate and index. Altogether, we have about 250,000 indices covering all sorts of themes as well as geographies. And on the back of just the ESG and climate indices, specifically just that part, we have about $238 billion that are tracking those indices. So there's quite a lot of investors that are working on that. So needless to say, we're very much at home with data analyses of all kinds. And so today, Esther asked me to share with you some findings from a survey that we've done with investors. So just to give a sense of what they care about, what it is that they want to look at in terms of reporting, what sort of data matters to them. And I think if you sort of look at it through that lens, it might give you some sense of what they consider to be material. So if you give me a second, I'm just going to show you my screen, and hopefully this will work. Let me know if we're good to go on full screen.
Great, it looks great. Yeah.
All right, lovely. So as you can see, this is the quote: institutional investors are moving from talking about policies and metrics to wanting results. So the survey that we did was with 200 institutional investors globally, and they have collectively assets of around $18 trillion. And we wanted to better understand their views on what they thought the most important investment issues were at the end of 2020. And we framed it around 3 questions. So first, it was what is the lasting impact of COVID-19? Second was what is the most important trend that they perceive for the next 3 to 5 years? And the third was looking at what is the latest thinking on risk management and diversity. So on some of these topics, I'll probably address them in the Q&A. I can see there's questions coming in. But to just talk about this survey for a moment, what we realized is many institutional investors are facing their greatest challenges for many, many years. They're transforming their investment processes at pretty high speed to reflect today's imperatives, such as ESG investing, as James had mentioned, and Shinbo as well, but then also innovative technology, and then the ever-shifting regulations and demands for greater transparency. So all of this is being done in a fairly unstable financial environment and a fairly complex one too. So the report showed, on one hand, how the pandemic has further accelerated the shift to ESG, and asked for the top 3 trends that will affect the organization for the next 3 to 5 years. 62% cited either climate change or the increasing complexity of ESG measurement. It's far ahead of other themes like we've normally heard, like market volatility and regulation. But that was not the only transformation. We're also going to talk a little bit about the role data plays in this, particularly during COVID, where we got a lot more data coming to light because people just were submitting a lot more data during that time. And then how technologies open the door for new ways of understanding markets and increased efficiency. So if you take a look at this first graph, I'm sorry that the words are quite small, but let me guide you through it. So the green circles are actually Asia Pacific. And in terms of priority for what were the top priorities for the funds, the first one was increasing regulations. So these were the 3 most impactful trends. And the Asian investors said increasing regulations are having the maximum impact at the moment, followed by market volatility, uncertainty, and then climate change with 15%. So the increasing regulations is at 25% in terms of impact for them as a trend. The Americas had put climate change first. Now, this was a surprise to us. We didn't see this coming. So that was quite interesting, with 24% of those investors seeing that as the most impactful trend for the next 3 to 5 years. And then increasing sophistication of the ESG measurements themselves at 19%, and then disruptive technologies. So on the ESG measurements and metrics, we'll talk about that in a few other slides that I have that'll talk about the data. And here in Europe, you see that market volatility, uncertainty was on top with 20%, increasing regulations because they just sort of got the EU SFDR regulations out. That was 17%. And then climate change and climate risk was down at 14%. Bear in mind, we did this survey, it's been quite a few months, and this was before they had the floods in Germany and before all of the fires across Europe. So I'm sure this has moved up the ladder in terms of ranking since then. So if we, one other thing I did want to mention is that, sorry, let me go back here. The report further showed how ESG has moved up in everyone's estimation as being the key factor. What we also realized is because of location, we're looking at very different priorities across the different regions. And so that was something that was interesting to note. What I also wanted to point out is the US investors historically were never at the forefront, if you like, of ESG, or in recent times they haven't been. But right now, there's been quite a surprise movement in that US investors have emerged as agile and more focused on disruptive technology than anyone anywhere else. So it started with the New York State Common Retirement Fund when they pledged to shed their energy investments that did not meet specific requirements to minimum standards by 2040. And since then, they've been progressively shifting assets into sustainable investment. So that's a pretty big move. And we see that as a growing trend. So let's look at what investors are focused on specifically. So again, apologies for the small print, but you will get these slides later. When we look from our perspective, we obviously do a range of things, and I think both James and Shinbo had alluded to something which is sort of screenings, where you look at what investors perhaps do not wish to invest in. So if you look at screenings here, and you just look at the 3 different regions, APAC, EMEA, and the US, you can see that there is a very large group of investors here in the US that are focused on screenings. Actually, all of them are, compared to if you look at some of the other factors or issues that they are focused on. Looking at ESG risk and opportunity integration, again, US leads the way, with Europe not far behind. What was interesting in the impact investment space, and how we measure it, is we actually look at a certain percentage of revenue that comes from impact on sort of social impact or environmental impact. And that could be determined by the investor. The threshold could be 25% or 50%, depending on them. But this is where you see all 3 regions are more or less at par. And that's a very recent occurrence. That this picture looked very different 3 years ago. And the rest of them, like adopting an ESG framework or active ownership or thematic focusing, they're all sort of probably not as high on their ranking as we'd like it to be. But here you go, this is climate change metrics, where we're looking at their focus on climate change. Again, although the average, sort of, if you like, their activities are at about 42%. If you had looked at that picture 2 years ago or 3 years ago, it would have been half of that. Finally, I wanted to touch on what are the investors looking at in terms of size. So when we look at large investors versus smaller investors, so again, the sort of block colored bar, that is the large investor, which we here have defined at 200 billion and above. And then the smaller investors are at this, the striped bar. And what you see here is large investors are clearly more focused on adopting an ESG framework, and again, whatever the task force for climate-related financial disclosure, so TCFD and PRI, they are the largest followers there, not the smaller ones. But again, what's interesting here is they're almost at par, and in fact, the smaller investors are ahead when it comes to impact metrics or looking at impact investments. So there are a number of issues here when you consider that there is ESG risk and opportunity integration. Again, the larger investors are ahead, and in ESG reporting, what we're going to talk about more, larger investors are way ahead. So there's a long way to come for the smaller investors here. So with that, maybe I will wrap up the bit that I wanted to talk about data, and perhaps I'll take it back to you, Esther.
Okay, great. Hi, may I have all the panelists switch on your camera, please? Okay, just to remind all participants, please post your questions using the Q&A button, rather than we have to switch everywhere from the chat box to the others. That will help us a lot. But now I have the privilege to start asking questions first. Yeah, but thank you very much for all the information and all that. The both report, actually, Shinbo and Chitra share, have something very enlightening. It's about Asia Pacific. So, and in fact, among our, today we have about 300 over, participants, and many are actually from this region. So maybe I could start with this question first. ASIFMA report actually covered the top 100 companies across 52 countries globally. And it is very encouraging to see that the sustainability reporting rate for companies in APAC region has gone up to 84%, a 6% increase from that of 2017. However, the report also says that there is still a lot more room to improve in terms of the quality of ESG data and disclosures to ensure that they are meaningful. So now we have actually heard a lot and about quality of data, whether it is comparable, consistent and all. So maybe it would be great to, have Shinbo to, address these questions about the quality of data that investor really want from a sustainability report. And is there any definition, make it easier for reporters to know what do you mean by more transparent and comparable and consistent? And maybe Chitra, you can jump in also. We'll also talk about APAC region. It's really picking up very fast. And I mean, being in APAC here, we really like to see this, this trend. And maybe James also, later on, maybe you can jump in also. So Shinbo, you want to start the ball rolling?
Sure. Thanks for that question. It's a good question, and it's definitely a topic of focus for our stewardship activities. We have been for a very long time asking companies to strengthen their disclosure. And maybe to simplify this, so investors, we are in the business, or it is important for us to be able to price risk and find return potential of a company. So when we say transparent, good quality, comparable, we are looking to data that speaks to financial materiality of the risk that is relevant to that company. So that we will be able to compare apples to apples with other companies in that industry. And, naturally, if these are companies in the same industry, the risk opportunity profiles are supposed to be fairly similar. But just as important is understanding how the board and management are looking at these risk factors, how they plan to mitigate these risks, but also to find opportunities to move the company forward. So companies, even in the same sector, although they may have similar risk, and return profiles, can have very different roadmaps that they set for themselves. And this is where transparency around the governance and the strategy really become important. And this is really the reason why we have recommended companies to look into TCFD and SASB, as these are frameworks and standards that focus on the financial impact or the financial materiality of climate risk and the broader ESG risk. And if you look at SASB, this is something that we felt provides a very industry-specific list of common risks, as well as teaching companies that these are the type of metrics that would be most helpful for investors and banks who are looking at financial materiality. And this is the recommended way to disclose on that, so that there is an apples to apples comparability across companies in the same industry and so forth. So maybe I'll stop there. I hope that answered the questions.
Yeah, Chitra, you want to jump in here?
I echo what Shinbo said. I wanted to add to that a little bit, in that this materiality map, which we create just for every gig sub industry, it's quite dynamic, so it's not static, and every year we see that moving. So if you can imagine what is financially material to a business, and you could look at it as in terms of what's a dangerous job these days, and it would probably be any frontline worker that would be a dangerous job, and so we consider that financially material, in that how's that company taking measures to protect its people and its clients. So that could be a hospital, could be a hotel, could be any of those things. Previously, we'd only be looking at heavy manufacturing industries or utilities and their safety, sort of health and safety standards. So that's sort of shifted post-COVID. So I just wanted to add that it's not static, and it's something that we measure and calibrate constantly.
Mm-hmm. Great. So James, do you have any thought on this? How Asia Pacific, corporates can really help to probably, close the gap and improve on the quality of data?
I think really, going back to Shinbo's presentation, what's crucially important is having a dialogue with with your shareholders. So understanding their needs, what they're looking for, from your sustainability reporting, and having that ongoing dialogue and relationship with them really can help strengthen your understanding in terms of, say, as Shinbo said, focusing on those issues which are material, but also having an understanding in terms of what are the particular reporting frameworks or standards that they are interested in you utilizing as well. So I think, the role of engagement is something that has really been increasing within responsible investment. And we see a lot of asset managers like BlackRock who have really been building out their capacity in terms of their engagement or stewardship teams in the region. And that's a trend I expect to see continuing throughout this year and the years ahead.
Mm-hmm. Okay, this is a related question from one of our participants, Nikita. And she mentioned that just now, since we mentioned about TCFD, this is a related questions. And in her opinion, there are various sustainability measurements and rating depending on how banks present to their clients, which could be confusing at time, in her opinion. And what is your advice to investor on how to pick their sustainability? Okay. Oh, the question jump on my screen. There's so many questions. Give me a minute. Okay. Traditionally, ESG reporting, using GRI has been led by CSR department in companies, but TCFD is quite quantitative and strategic in nature. Which department is best placed to lead TCFD? Would it be finance? Maybe I can, anyone want to answer this first? And I will share our pain as well as a reporter. Yeah.
Why do I get the feeling everyone's looking at me? So why don't I take a shot?
You started it, so I'm just going to let you go.
Yeah, sure. Esther, I think you raise a good point. I think this whole journey towards sustainability reporting, and now we're talking about metrics, targets, financial materiality. But if we all go back, I think this all started more of a PR exercise, something that has to do about, showcasing as a company, as a corporate citizen, we are responsible entities. This is how much good we are doing to our stakeholders. And so the natural progression of that reporting responsibilities used to be more on the communications team, or maybe the investor relations team, or even the marketing team. And so I think there was a bit of a difficulty in that transition, as more focus is now coming from investors on financial materiality, looking at numbers, looking at metrics. But I don't think we should discount that. I think sustainability, and to any company, they have broad range of stakeholders, and they have the responsibility to communicate with a broad range of stakeholders. And so I don't think any investor is denouncing existing frameworks, that they should all switch over to these new TCFD framework and whatnot. I think what investors are now focusing is that, okay, that's great. Let's continue doing that. But for those who are more interested in the financial materiality of this, so the investors and the banks, these are the type of data or information that would be very helpful to us. And so I look at it more of an add-on rather than a complete transition away from existing frameworks to new ones. And just to reiterate why we believe TCFD is a good framework, it's not a standard, it's a framework, is that it talks about 4 key pillars. One is the governance around it, because a lot of the actions and the strategies and just the thought process behind how a company is going to address climate-related challenges. It's a systemic issue. A company alone cannot solve this issue, but it is an issue that we all are going to be exposed to. So there needs to be an element of governance from the top in terms of how this is going to be incorporated into our survival plans going 10, 20, 30 years into the future. So there is that governance aspect to it. There is the strategy aspect to it. This needs to be baked into the company's long-term roadmap strategy. There is risk management component to it. And of course, how are we going to measure ourselves, and how are we going to share our performance to those interested in this? And so there's the metrics and targets. I would argue that that framework would apply to not just climate issues, but broader ESG issues. So again, I would like to emphasize that, you know, I don't think investors are coming to companies and saying, ditch everything you've done so far and go here. I think these are some information and aspects of information that we would like to see. And this is a great framework for you to consider in terms of reporting on not just climate, but the broader set of ESG related risks and opportunities.
Mm-hmm. Yeah. Okay. Now, while she want to add on, Nikita, say who should be leading it, you know, within an organization? Is it the finance people, or is it the CSR people, or even the comms people? Yeah.
Well, Esther, I think you'd probably have more insights on this, but I think it is because it is a strategy issue, because it is about long-term decisions. I think the organization, if they have a dedicated sustainability function within the company, that might be it. If this should fall under the overall corporate strategy function, I think that would be another reasonable one. But what I'm saying is that sustainability reporting shouldn't be about, you know, we want to showcase the things that we're proud of only. This is not about compliance. This is not about marketing. It is more about strategy. So I think functions more central to that thinking and that coordination capacity should be the ones looking at this.
Yes, wonderful. Chitra, would you agree to this, or you want to add any thoughts?
I think Shinbo's covered it very well. I would say one thing though, that to his point, I know a lot of companies find that it takes a lot of bandwidth, you know, this reporting and all the different types of reports that they have to fulfill. But I actually believe that getting into the weeds sometimes helps companies discover or uncover risks that they may not have even been aware of. And I think that's a really important point, because under all that work, the issue really is for companies to have a complete handle on what they're doing and the impact of everything that they're doing. And that's not always apparent. If you're not looking down your supply chain, if you're not looking across your entire, you know, sort of the value that you bring and the impact that you have, it's hard for a company to then know, and that might be a positive impact, in fact. So I think it's probably a good exercise. It does belong in part in strategy, but the strategy and the operations have to be structured and seamless in this sense. And the measurement of these metrics, once in place, they just fit right into a business as usual model in the end, if it's done properly. I know it takes time and a lot of effort, and Esther, you really should speak to this point, because this is right up your alley.
Yeah, okay. I will share our pain and joy, you know, of our after publishing 14 sustainability reports. And of course, I do not agree that there is like, we need to split hair. Okay, for sustainability to work and ESG to work, we really cannot work in silos. Okay, and it is good to have a dedicated sustainability team, but this team should also be integrated into, you know, the whole, corporate structure. We actually at CDL, our corporate structure is very simple. Sustainability team only report to the board sustainability committee, comprising 3 independent directors and chaired by our group CEO. So we have the advisory and supervisory, advice from our board, and we also have operational mandate from our group CEO. And in turn, I chair a sustainability committee that cut across all business units and operational units, be it HR, product, asset management, even, the sales and marketing, everyone. So I will feel that actually from experience, sustainability team should be, playing a strategic role, empower as independent, but truly integrated into the operations. We set goals and targets, but we must know, how we can engage operational unit to deliver and also to track. Tracking is very important. And in the good old day, of course, ESG were considered as non-financial. So, the financial team that said, oh, no, it's not my business. No, today, everything to do with ESG has financial impact. So in fact, if you're talking about the so-called hot soup of alphabet, whether it is GRI, TCFD, SASB, IRR, CCDP, and you name it, we have it, SDG, CDSB. So what we feel is there's no one size fit all, because everyone's industry is very diverse, audience is very diverse. So you really have to, find the solution and a blended, framework to address issues that are most material to your business and to your investors and stakeholder. So just now we talked about materiality study, which I'm going to ask your opinion as well in terms of we have found it very useful, because we think what is material to our business may be different from stakeholders and investors. So from the responsible investors perspective, James, maybe I ask you first. Are you more impressed with company who come up with a sustainability report based on their materiality study?
Yeah, I mean, I think from the presentations earlier, I think everyone can understand that materiality is a kind of key aspect in terms of which ESG issues, what ESG data is going to be of relevance and most importance to investors, so that they can properly, or to be decision useful, so that they can integrate this into investment analysis and decision making. So certainly that's very important. And it's not just that a materiality assessment has been undertaken, but it's being able to disclose much greater information around that entire process, so that investors can understand how it's been undertaken, what different aspects have been considered, how these deliberations have been undertaken, and the conclusions reached. One thing I will say, and this is much more forward-looking in terms of, I guess, the future of sustainability reporting, Shinbo, BlackRock might not agree with this, but increasingly the PRI, as I mentioned, we're starting to look and our members are starting to look at sustainability outcomes. And so in Europe, for example, you see a greater talk around double materiality. And so this is not just looking at the impact or potential materiality of ESG issues on a company's performance, but it's also looking at the sustainability performance or impact of a company on their wider stakeholders across a range of sustainability issues. And so this is something, again, for corporates who are looking to undertake a materiality exercise, starting to think around that double materiality lens. And that is information that, I think in future years, investors will increasingly be interested to understand, so that they themselves can realize and be able to quantify the outcomes of their own investment portfolios, whether these are positive or whether they're negative. And these are then aligned to frameworks like the SDGs, like the Paris Agreement, and others. So I think that's a move we're starting to see within the responsible investment space, and it will then translate into the types of information investors are looking for from corporate reporting, moving beyond a more traditional materiality lens to a double materiality approach.
Mm-hmm. Great. The other two speakers, do you have anything to add on, or there are quite a number of questions that So actually, Shinbo, you seems to be have a lot of questions. So
I've given up trying to track all the questions, but maybe just to add on to what James was saying, and I think this is an important distinction that I would like to share with the audience, is that although we are one firm, BlackRock, we serve clients. The assets that we manage are all our clients' assets, and these clients have very different investment motivations. I think this is very important for companies to understand. So some of our clients simply do not want to go near certain sectors or certain companies. I want you to build me an investment solution where you exclude XYZ, just screen them out. James earlier referenced, negative screening, positive screening.
Mm-hmm.
And on the other end of the spectrum, and very relevant to what James just shared, is we want, and we do see a lot of client demand, especially from our EMEA-based clients, that double materiality outcomes, alignment to things like the SDG goals. These are investment motivation for some of these clients. So they want us to come out with investable solutions and portfolios that track that. or you can even go into the impact space. Some clients come to us and say, I want this capital to be aligned to an outcome, whether that is environmentally charged or motivated or socially motivated, but that's where I want to invest this money. And so we have to provide them with a very broad set of investable solutions, if you will, or strategies. In the middle, and I think many of you in the audience understand that as an equity investor, we are predominantly a passive investor, i.e. we provide very low cost solutions for our clients to be exposed to the overall stock market through ETFs, what we call iShares and index products. And so we are perennially almost a permanent shareholder to many of these companies in the index. And so divesting is not really an option for certain strategies. And so we need to understand, okay, in that sense, then how do we reduce the risk in that portfolio? How do we help companies transition towards what would be more viable over the longer term? So even within under one investor, you would oftentimes see that they deploy their stewardship responsibilities, their responsible ownership responsibilities through very different modes. And so there is no one size fit all in terms of what do clients want or what do investors want. It's a very complex problem. But I guess more importantly, this is why a lot of investors are asking for data, because that data will help us address a lot of these very complex and very varied demand in terms of how clients want to align their capital.
Yeah, I totally agree. And there's a couple of questions which actually ask, how, asset manager like BlackRock monitors ESG progress of its portfolio company. And this question probably I can also have to highlight. The next one is like, do you only focus on the past sustainability or ESG issues, or you look at the future? And, so if that means this is like whether it's past or forward-looking, data. Yeah, maybe, Shinbo, you can start first. Maybe Chitra can help.
Past data versus forward-looking data, I would say they're both important. Companies are not static. You don't take a snapshot of that company and that's what that company is going to look like forever and ever. It doesn't matter which industry you are in. And even if you are in the same industry, companies can set very different pictures for themselves in terms of what I want to look like in 5 years, in 10 years. So those forward-looking targets are very important. But at the same time, I think past track record also provides us with a lot of insights. I think I've seen this question in the list, but if a company, let's say, is in the palm oil industry, it's a common issue here in this region, and that they have issues pending from 10 years ago that is not resolved. We would, the best way for us to understand is we go down and we engage with those companies, see what are those pending issues, what are the kind of practices, steps the company has taken to resolve them, what are the hurdles in getting them fully resolved. If we have a view that the company has done everything in its power to resolve them, but it's just regulations, maybe it's just the unique aspect of that particular controversy that companies just cannot pull this out of, then we take that as insight. And then we also put that into context in terms of what the company has done, also what the company plans to do. So it is a holistic, it is a very dynamic type of insight that we would like to get through engagements. Of course, relying also very heavily on the kind of insights that MSCI and these independent data providers can also shed light on.
Yeah. Okay, MSCI, you are mentioned. Chitra, over to you now.
Thanks, Shinbo. And I don't know, it's always a hard act to follow after Shinbo said his piece, but I'm going to attempt to do that. A couple of things that he'd mentioned a little bit earlier as well when he was talking about how you could have companies in the exact same industry with the same sort of revenue, but with a very different sort of profile. And it's not just risk, and to address his point now, it's how they're managing that risk and how they're looking ahead and what they're doing to plan ahead. No company at the moment is perfect. And I don't think every company can claim to be on a net zero path that is 100% achievable. So I think, but what you do want to see is that those steps are being taken. So one of the metrics we have, when we look at the ratings, there's a trend. You can look at historical trend and you can see the companies getting better and better, particularly on, some of the key issues. But then you've also got mechanisms in the market now that are, to incentivize companies to go on that path. So you've got sustainability linked loans that are coming out. You've also got, mechanisms by which it may not just be linked to your overall score, but then to one metric. It might be your emissions. They might say if that keeps getting better, then you can, your cost of capital comes down because they're offering you better rates as you go on. So, and if you look here in Singapore, the MAS has green grants. So again, they're taking different metrics into account when they're trying to incentivize you to change. So one, it's about changing corporate behavior. And I think that's, a given. We're looking at that having to happen across all industries. We're not just maligning one industry and saying it's all on your shoulders. So I think we need the entire system to move along. And for that to happen, you need players like PRI and TCFD that are starting to give people guidance on how to do it. You need regulators. Frankly, that goes hand in hand with all other market mechanisms that exist, because without that, it doesn't work. And if we're looking purely from a data perspective, we're working on something right now it's already been launched, but it sort of does scenario into the future. This is basically different scenarios and stress tests that looks at a 10-year scenario. And it's able to look, rather than just looking backward as we've spoken, and your carbon emissions, what it's able to do is look at climate change as something that's going to impact your business. And if it continues at the rate it's going, it's probably going to be a negative impact for most. So then when you look forward and then you look at how that impacts your valuation, we've got that tool that runs these sort of scenarios and stress tests. Then it's quite easy to track, work it back and get a net present value. And it's usually a wake-up call for many people to look at what they've got now and the risks that it might pose in the future, and how, they want to be managing it. So yeah, I'll stop there because I think James has got something to say. I've seen him taking notes.
Mm-hmm. Okay, James, over to you. Then after that, there are two more questions for Chitra. Yeah.
No, I think those points are really, are really important to make. One, I think, is just around, the opportunity or ability to improve. So if you are a lower rated company, it doesn't completely rule you out in terms of someone who's a dedicated, responsible investor. But again, as Shinbo said, it's about how you understand and recognize these issues where there's room for improvement, and then having a strategy and intention in place to demonstrate and make progress over time. So you still have investors who are looking for companies who may be lower performing on some of these ESG metrics, but again, have recognized and demonstrating a commitment to improve. That can be just as important and a way to create value and capitalize on growth around that. The other aspect is just around that long-term perspective, and when we're looking particularly around these systemic risks, so climate, of course, there's also the task force on nature-related financial disclosures, which is being developed currently, and biodiversity risk and loss is going to be a huge issue in forthcoming years. So I think this forward-looking aspect of TCFD and increasingly of other frameworks is really important, because there is such a huge difference when we look at, say, on climate at 1.5 or 2 degrees of business as usual. When you look at the potential implications across those different potential futures, there's a huge variation on the impact that will have on different businesses and sectors. And so I think this is going to be something which is increasingly important for long-term strategy and development for businesses.
Yeah, James, since you are on the stage now, there's one question from Sarah Martin that he asked that whether you can tell us a bit more about the net zero asset managers initiatives. And there are not a lot of asset managers from ASEAN who are part of this now, right? How we can improve on this. Yeah, over to you, James.
No, absolutely. I mean, it's a very good question. I think what we see is there's a strong membership, both for the Net Zero Asset Owner Alliance, but the Net Zero Asset Manager Initiative, much stronger participation from, I think, institutional investors based out of, North America, based out of Europe. We do see some from Japan and Australia, but across, the rest of Asia, the participation is still very low. It's something that the partners who coordinate this have certainly recognized and are trying to ramp up the level of engagement and communication around these initiatives to try and increase that participation. But I think, in part, many investors are cautious around making commitments like as are required by these initiatives because of the lack of data that they find in emerging markets, for example, to be able to, I think, be confident in transitioning to, a net zero portfolio by 2050. So they do, I think, have a number of concerns. And obviously, when you think about the development of the region and what's realistic for companies operating in emerging markets, then it is a much more difficult transition and a much more difficult picture. So I think that is part of it. It's around access to data and having confidence that they'll be able to make that transition. But I think maybe as well, you're not seeing the same pressure from, say, the asset owners as of yet for local asset managers to make these commitments. And also you're not historically seen the kind of regulation in place that's driving asset managers to start really focusing in on climate risk management and disclosure. That has been changing very recently. Singapore with their environmental risk management guidelines, Hong Kong just in the last few months have announced changes to their fund managers' requirements around climate change risk management and disclosure. So I think as they become more confident in their own approaches to climate risk management, they will become more comfortable in making these types of commitments.
Wonderful. This leads me to the next question, which is actually from a very good friend, Chongha Chia, who's based in Korea, a very passionate smart city climate advocate. His question is for you, Chitra, that about climate change matrix have been shown to be very low on large and small investors. Isn't climate change the very reason we are all doing ESG in the first place? That's question one. And why are climate change matrix not being covered more? And is it dangerous that we are not measuring what we need to manage towards net zero by 2050? So this is one. And a related one from Nora, and also similar, that can you expand on how are the smaller investors ahead in impact metrics but behind on ESG reporting?
Right, so let me take that maybe one by one.
Yeah, it's on the Q&A box. Yeah. Mm-hmm.
Yeah, no, I am there, but I can't seem to see it right now. So sorry, this was a question by Chonghua Cha. Okay,
yeah,
got it.
Yeah.
So isn't climate change the very reason we're doing ESG in the first place? I guess it's one of the reasons, right? And it's the most, right now, it is one of the most urgent problems that we face. But ESG has three components to it, right? So it's got environment, social, and governance. And we have a chart. I don't have it here, but we have a very illustrative chart of the issues that impact the performance of a company and controversies that impact the performance of a company and the valuation of a company. And it's not always the E pillar. So you have a host of S issues, social issues that cause big risks to companies, and governance above all. And Shinbo mentioned that earlier, that you have to look at the governance. And for us, when we start an ESG rating, we actually start with the G pillar first. It's the cornerstone. We sort of feel if the governance is really tight and good, then the other, E and S will follow. So just to explain, there is a difference. Climate, yes, it is definitely front and center right now with the COP looming up. We can hardly think of anything else at the moment. The metrics that we're looking at, clearly for us as a data-driven company, we've just got loads of metrics that we look at. There's almost like 500 data points that to us are important and material, and we try and map those out. But to to address a different issue, and not all companies are mapping out all of these metrics. So we look for them, and we're trying to look for them through alternative data and other ways, not self-reported, not necessarily. But I think what helps, again, going back to what James had said and Shinbo, is that really helps to have guidance like TCFD, because it almost forces you to look at these metrics and say, right, this is imperative, this is what's important, this is what we need to measure, and what gets measured gets managed, and that's what they say. So that was, I think, the second part of the question. I'm trying to scroll down to, what was the other question? Who was it from?
I think we more or less answered that, and there is actually another one which is from Rakesh, just part of it, because we are also running out a bit of time.
Okay.
So Rakesh asks about, like, with regards to second priority of increasing sophistication of ESG measurement, are these measurements being used for validating impact?
No, I don't think it's that. So when we look at increasing sophistication of ESG measurements, what it is, well, there's two things. One, the world of data has changed, exponentially just in the last 5 years. If you look at the amount of data that we have now, way more than what we had before. If you look at the amount of transparency that is being requested of corporates and investors alike, just in the last 5 years, again, there's a huge amount, whether it's reporting or otherwise, that they are having to do. The third point is, again, James brought that up earlier, which is the consumers, the people. They want that transparency. They're asking for it. So if we look at increasing sophistication of ESG measurements, it's a response to all of these different, if you like, requests that are coming from all of these different parts, the regulators, the market, and then in part, I guess, the public want to know, are we actually buying goods and services from a company that is credible? So it has to get more sophisticated. It just has. Is it going to continue on that track? I'm afraid there's no going back. And I think James and Shinbo can attest to that. There is an increased scrutiny, and the type of questions that need to be answered today, they have to be backed by quantitative and qualitative data. I don't think greenwashing is going to cut it anymore. It might have been. I know that just a few weeks ago, a very large firm that we all know got called out on it. But so it is still a thing, but I don't think it will remain a thing. And that's actually what this is. It's not about ugly truths being sort of brushed under the carpet.
Well, in fact, I think even our Singapore Stock Exchange already pushing out the consultation. One of the requirement is to improve the data integrity by requiring reporters to have to conduct internal audit or external assurance, and also come up with a 3-year plans for TCFD embracement. So I have to really ask I'm mindful that we are already at 5:30, that I need to ask for the approval by the panelists, that whether you can stay for another 5-10 minutes or so. Yeah, okay, wonderful, thank you. So I will try, all the participants, thank you for your question, but there are like 30 over questions. I'm trying my best, and please don't scold me if I cannot cover your questions. Okay, this one is from Francesca, and she was saying that regarding the complexity and the interrelationship and increasing number of ESG data, what is your advice on how different teams, can work together and define parameters such as sustainable procurement and environmental data and performance? I think I can share her pain, because in an organization like us, we have to talk to the project boys to take care of the, the design, the development. We also have to talk to the asset management people. How do we manage it and engage tenants? And then in the end of the day, we also have to go upstream, sustainable procurement. And of course, we also have to track and report. So it's a really matrix that it's not easy for reporters. So any thoughts, investor? Help us, how do we, assign different teams to do that? This is Francesca Viliani. Yeah.
Esther, I think you just answered the question perfectly. I mean, who better can answer this type of question than a practitioner, right? I mean, I don't think there is one recommended framework or one method that we think works best.
Yeah.
And I don't think it's in the investor's realm of knowledge to be able to dictate how a particular company should go about doing it. But, you know, we would like to hear how a company has decided to approach the topic and structure the way around that. So perhaps this is not a question that an investor can answer, but maybe more of practitioners like yourself could provide insights to many of the audience here.
Yes, actually, I have more or less shared that. Yeah, for standard, there's really no one size fit all. And in fact, we work really, really hard on the ESG disclosure. You know, there's so many ratings and rankings. And in fact, today we are living in a very, very transparent world. Just now, Chitra talked about greenwashing and all. And it's all about transparency. And if a report that is not, you know, externally assured, I'm sure investor will sort of like, I'm not so sure whether these data are credible or not. So I think we are all share the same thing. We try very hard as corporate reporter to present data, and that is validated, that is you know, as accurate as possible. And so James, do you have any advice from the investors' perspectives? What do you expect, and what do you think that, oh, this report is really a good report, you know?
I mean, is there really kind of like an X factor, like, you know, when you're looking at a sustainability report? I don't think so. And I would actually, you know, echoing Shinbo's thoughts, I'd actually hope not, because I wouldn't want to encourage kind of shortcuts or laziness. Really, it's about a focus on substance and not flash. So I think some of the key things in terms of what makes a good sustainability report is a focus on clarity, it's a focus on level of detail, and it's also reporting which allows for that comparability of disclosures with other players who are across the same industry and sectors and globally as well. So it allows investors to make an informed evaluation of a company's performance. And I think increasingly, I think as Chitra mentioned, investors are increasingly able to tell, you know, to see through where this is greenwashing, to be able to tell where a report has been created and approached just either as a box ticking exercise, or if it's just been outsourced, you know, to an external consultant, and the exercise hasn't really been taken with as much seriousness as it should be, and real value within the company. So I wouldn't say there's, you know, any X factor, any one thing which is going to stand out, but a lot of it is around kind of the clarity and the level of detail, but lets an investor really understand how sustainability risks and opportunities are being managed and you know, understood within the organization's operations and long-term strategy.
Great. Chitra, do you have any advice?
Well, I think it's all been said. The only thing I'd say is if a company is truly embracing sort of the values and mission together with its operations and its strategy, then that reflects in any report that they're going to draw up. I think just putting a very shiny veneer on what they're actually doing, that it doesn't last very long. And to James's point, these days we just have access to a lot more data, so it really doesn't go very far. So I think the key thing that one should be looking for is, does it actually cover all aspects of the business and its impact, positive and otherwise, because that is the only way that one can see progress over time. If it keeps looking amazing, then the following year, how do you beat amazing? You've got to have metrics that are real, and then that are trackable, and then where you can see the trend, and that for any investor is quite important. That authenticity has to be there.
Great, Shinbo. So you agree that a very attractive cover design or a very clever tagline won't work, right?
Yeah, and I think if I may just briefly reference back to that ASIFMA report that I talked about in the presentation. It talks about what we actually observed engaging with companies looking at the reporting and talk about certain expectation gaps, what investors would like to see and what we actually see. And so maybe a lot of the questions posed from the audience today, there could be some useful real life cases we've put in there as well. So it could be a resource that would be helpful. And again, I think to understand where investors are coming from, understand what their expectations are, I think it is important to engage with them. And so if I can take this opportunity, I would really like to ask that companies consider putting your leaders, your decision makers in front of your shareholders and engage in this conversation. I think everybody would agree that this is a long-term journey we're all going towards. And we're not looking for perfect because we don't expect that to exist right now.
Yes, fantastic. Yeah. So I think, well, to conclude, our key takeaways from the insights of our really amazing panel, is, and also very robust, questions coming in. There are a few key takeaways that I can conclude. ESG performance is really the core for investment decision now. And institutional investors are not only looking at data-driven, information, but also are increasingly looking at the culture, the leadership, strategy, and also the whole organization approach, if I can, represent that. And then the other one is investors value dialogue, like what Shinbo have said, and try to interact and be active, in engaging them. And then the board and top leaders are being, engaged now to look at ESG. Gone are the day that ESG is good to have, but really is at the core of the business. And investors are also taking a long-term view rather than short-term, looking at, the past data, but also very importantly is the forward-looking targets and goals and strategy. So with this, I'm really, really very thankful for all the information, and thank you for all the participants, and end up we have about 300 over log in, and thank you so much, and do look out for the next webinar, and we will try our very best to come back to you with some answer to your questions. And there is a post on the chats also. There is actually the recorded session will be on our cdlsustainability.com YouTube channel. With this, happy Friday and have a wonderful weekend. Thank you all. Bye-bye.